Oh, very good. So, all right. So, my thanks go to the Henry George School of Social Science and active program there on some political economy issue. And it's well organized from the Henry George School. Hima is the chair of this session here. And what we want to present is a kind of, trial balloon to having some idea of how to prop up more the discussion on climate protection and financing climate mitigation. And we were thinking about a particular topic, namely on a tax on carbon intensive wealth. You will see why this is a new topic somewhat, but it's on the other hand connected to a number of other important current issues, and which I will introduce you briefly in about 5 or 10 minutes. Then my co-author, Jose Bastos Neves, will continue with the next presentation, with the next steps. I want to also refer this to the first topic that here you see the first line. I will speak about climate change, wealth distribution, and public goods. When you talk about taxation, though, Henry George was one of the first great 19th century author who thought about, well, a land tax. A land tax is basically what was the expansion in the US and the rising value of land. You could get rich with this, right? So, and he introduced the idea of a land tax. And in some ways, this is related to his idea, because we're not thinking only about the land tax as a value, a tax on the value of land, but land usually also, implies some mineral rights. So, for example, you can extract fossil fuel and oil and gas and all kinds of valuable resources from that, and then sell it, and you get rich, so to speak. And Henry George was calling this rent from land as an unearned income. And in some sense, this unearned income, so getting rich from fossil fuel, has similar features, you see, and it might be justified to have their more explicit tax treatment on this, as Henry George proposed to the land, to the value of land. So now I want to show now in the next step some connection of our paper to three major currently discussed big issues beyond the thought about Henry George, namely climate change, wealth distribution, and public goods, or public funding of publicly available goods or bads, as you will see later. So climate change is one of the most important current topic in politics in the US and Europe, everywhere. The challenge from climate change and mitigation of climate change and climate protection is an important issue. But also, as you see, the other issue is the rising wealth inequality that we have in the US and Europe and other parts of the world. The Gini coefficients for wealth is worse than for the income, the Gini. And there's a big, heavy discussion on, well, who's going to pay for the state expenditure and for public goods, or for the mitigation of climate change. Yeah, so these three things are very currently very big topic, very timely, very much in the public debate. So The first topic, climate protection and climate challenges. So everybody has seen this. So with the increasing disasters and weather extremes, the frequency and the severities of disasters are rising. For example, weather extreme, winter get very cold, summer get very hot. You have forest fires, you have landslides, you have sea level rise and floods, and you have big storms, you have very hot and warm days. These climate or weather extremes produce a lot of events. And these events, we try to study them in terms of frequency and the severity of these events. And you can see that on the right-hand side, the red line that you extracted from data from roughly 1970, 80 here. The red line is the temperature rise, and the blue line is the CO2 emission, stock of emission in the atmosphere. So as you can see, now they are roughly moving parallel. There's a high correlation between them. And so what we studied in some of our work is how are the frequency and severity of disasters connected to this. So, and you can see, so the droughts are higher, slightly, extreme weather event and extreme temperature are going up, but particular flooding is going up heavily, as you can see. And these are the storms, hurricanes, typhoons, and so on. You can see how they are going up. Here are the wildfires, and here are the landslides. These are data from university website of Belgium, EM data it's called, and they are actually available from 1900 on until now. But here are the most 40, 50 years data here. So you see the weather extreme events also going up with these events. So climate protection is now one of the major, has become one of the major issues in the public debate and in many conferences. And one of the earlier instruments to mitigate the climate, to prevent the rise of the CO2 emission, was the carbon tax. And so the carbon tax has been adopted in many countries, particularly in Northern Europe. The carbon tax has some coverage now of the total CO2 emission, up to 20%, but it's not very effective. So there carbon tax is increasing and the revenue of this is increasing, but it's still not very effective. And the goal of the Paris Agreement and the recent agreement in Scotland was that, so in 1930, so roughly the carbon emission should be, the net carbon emission should be half of this. So roughly here now, and in 2050, the carbon emission should go down to zero, the net carbon emission. So because there's still carbon emission going on, but there's also some dissipation of carbon in the atmosphere, so the net carbon emission should be zero. This is roughly the commitment in these conferences, and this is what actually is going on. You can see it's not much decreasing now, the carbon emission itself. So now this is one big topic in the public. And well, the other big topic, timely and heavily discussed topic, is the evolution of the inequality of wealth. So here, this is mainly was triggered by Piketty. Here you can see the wealth evolution since 1920s. For the first, this is the 1% wealth share of the population in different countries, and the US is the blue line here. And at that time period here, there was a high income tax introduced. And so the high income tax drove down the ownership of wealth of the 1%. But then since the 1960s and 70s, it's rising again in almost all countries, as you can see here. One of the income tax was reduced. Another trend was the actually the corporate income tax was also reduced. And here's the line for the OECD, as you can see, and for other area, Africa or other Asian areas, you can see from 35%, it's now roughly 20% the corporate income tax. So that's also, of course, leaving much income and wealth more in private hand and less in the available for public action. So that's another trend. Now, we have done the following study that is using the survey of consumer finance in a paper. It's also social science research network paper with Parker and myself. And we are plotting here on the horizontal X some kind of normal income. So that would be very low, that's going up here. But with that, as you can see, as a normal income is going up, the income and the gains from wealth is rapidly going up. Yeah? In other words, a great component of the higher income level of the population is constituted or caused by the income from wealth. Yeah, so in other words, that's driving the wealth income, measured as capital gains on this X, is driving for certain types of income the wealth, as you can see. So the wealth income becomes more important than the actually wages and salary as driving wealth distribution, as you can see here. Yeah. So the last point is this one now here. If one thinks about, well, that these economic activities and the huge rise of industrialization and the rise of large corporations and huge economic progress, we have increased the GDP by a factor of 12 or 15 since the end of the 19th century. There is increasingly an emission of CO2 emission going on. And there is now the question, well, how to pay for it or how to stop this. Now, there is an old theory in public finance that's called the proportionality principle. And this is new what we introduce in our paper here now. Namely, proportionality principle means so those groups or those individuals that have a higher consumption of public goods should pay a higher tax. That's the proportionality principle. That was developed in the 19th century, also then in public finance. Wixler, Linder, Musgrave has big discussion on this, on the proportionality principle. You use more public goods, therefore you have to pay more. Now we reverse this and we are saying, well, but there are groups and firms and corporations and industries that produce more public bads, namely the CO2 emission, the externality, the long-run effect on temperature and on the climate disasters. Well, then they also have to pay more because they produce more public bads, just using the proportionality principle again. As you can see, that's basically the application that we try to do. And then that will help to reduce the carbon emission and maybe also solve to some extent the wealth distribution issues. And this was maybe I left out one slide here. There were a lot of proposals nowadays on correcting the wealth distributions. And these proposals were triggered by the Piketty research there. And there's either a tax on companies or individual net worth tax. Though in other words, it's a tax on wealth, on general wealth. It's not a tax on specific, so to speak, carbon intensive wealth. It's a tax on in general wealth. But wealth is not necessarily all bad. It could be very productive and very welfare enhancing, but there's certain type of wealth that's not welfare enhancing. So this discussion is heavily going on, and the economists in theory, they say, well, having a tax on general wealth, this is a tax on capital, and this will reduce employment and growth in the future. That is a famous Willi Semmler zero tax, capital tax theory, which is doubted a lot nowadays in another literature. And the general wealth tax is very hard to operationalize, in the sense to make it practical, because it's very difficult to measure general wealth, the stock of general wealth. So the second or third house adding to that, or is it just used for home? So then there is practical measurements error, and most countries in most advanced countries have tried this many times, but the wealth tax has so tapered out and has not been very effective. There were also, of course, there's capital flights and so on that will stop that will work in the opposite direction. So a general wealth tax doesn't seem to be so effective, because it's a tax on the stock of wealth. So we are proposing now, so to speak, a wealth tax on a tax on carbon intensive wealth, and we don't suggest to impose this on the stock of wealth, but rather on the flow of wealth, of the income from this carbon intensive wealth. And this is now the point where I pass this on to Jose. Jose, can you take over?
Sure, let me just, yeah.
Okay, good.
I'm gonna share my screen here.
I can stop sharing, yes.
Yeah. Can you all see my screen?
Yes, we can.
Okay, so let me just. Okay, so thank you, Willi. I'm gonna continue the presentation of our paper. And in the section 2, I'm gonna talk specifically what we mean by this carbon wealth tax. So mainly the goal is to shift investment and to shift investors away from carbon intensive sectors and capitals and wealth and into green companies, green wealth, right? So it's equation 2 here, equation 1. We have the logarithmic return of an asset, of an asset price of whatever kind. And when we talk about a carbon wealth tax, we're thinking about applying a tax on this specific return. So what we mean is an extraordinary increase in taxation for capital gains of carbon intensive companies. Provided it is high enough, this is equivalent to taxing net worth. This is a result shown in Gunneven and co-authors paper from 2019. And the main advantage is that its implementation is straightforward, given that in the United States, for instance, the IRS already oversees capital gains in the tax filing from persons and people and firms. Equation 2, we explore the potential use of tax revenues, the carbon tax revenues, to fund green subsidies. So this is what is known in the literature as the second dividend. For instance, the classic reference here is Nordau's book from 2013. And so in terms of the green revenues, it would increase the subsidies increase the revenues compared to the general case. And the last term is just an adjustment term here that we use that takes into account the size of the tax base. Let me just move on. Okay, so but really the main issue here, one of the main issues in our proposal, is to come come up with a way to discriminate between carbon intensive and green companies. Looking in the literature.
Jose,
yeah.
they don't show the presentation, the slides.
Nobody's is seeing my slides?
They are not moving.
They're not moving, right?
Let me see what happened here. Resume share. Okay. I'm gonna stop sharing and share again. This never happened to me before. Sorry about that.
Yeah, I was wondering.
Yeah, so
now.
Can you see now?
Yes.
Is it moving? Sorry, so this slide, I had the two equations that I spoke about before. The idea here is, as I was saying, is to come up with a way to discriminate between carbon intensive and green companies. Looking in the literature, the most widely used source of this information is the input-output data. For instance, the World Input-Output Database is used by many authors. But the problem for us is that they basically tell us how much pollution each economic sector produces. Whereas when we think about taxation, we have to assess the company level carbon emission, right? So because of course taxation is usually levied on companies. So talking about company level data on carbon emissions, there are some initiatives like the GHG protocol and the Carbon Disclosure Project, and there are others as well, that aim at producing standardized, comparable, and publicly available CO2 emission metrics. So usually they rely on what is called the three-scope methodology. The first scope being the direct emissions from the company's activities. For instance, airlines would be for instance, the emissions produced by an airline would be comprised of its fuel consumption. The second scope would take into account the emissions incurred during the generation of the purchased energy for a company's activity. For instance, the emissions coming from the power plants used in utility electricity provider. And finally, the third scope is the more encompassing one and takes into account all indirect emissions. So take into account both upstream and downstream value chain of the reporting company. And just another comment here, a side comment, when it comes to wealth income data, then because we are dealing with mainly the flow of revenues coming from wealth, this is already exists in the tax filing. For instance, the IRS in the United States uses or require firms and individuals to report its capital gains, for instance. So this wouldn't be so much of a problem for us here. So the main issue then is, of course, how broad is this firm level data? And in that sense, we see that in the several countries, there have been some disclosure efforts from regulatory agencies that are requiring companies and firms to disclose information on carbon emission of their activities. So for instance, in the United Kingdom, the Bank of England is concerned with calculating the amount of emissions that is coming from its portfolio holdings. So the firms and corporates and companies that issues bonds that are held by the Bank of England have to disclose emission information. So, for instance, by 2025, they will require all these companies to disclose Scope 3 emissions. In the same vein, in the European Union, there is what is called the European Union Taxonomy. That is a document that has firm level mitigation and adaptation actions that they require from the several industries from different sectors. So as of now, it already comprises over 80% of CO2 emissions, and this number is likely to increase in the near future. This year, in 2022, in the United States, the Security Exchange Commission proposed to include in the the publicly listed companies requirements the disclosure of Scope 1 and Scope 2 emissions, and in some cases also the Scope 3. And there are other initiatives, especially multilateral initiatives, for instance, the Task Force on Carbon Disclosure, that is more of a recommendation. So it's not mandatory, but over 1,000 companies with net worth over $200 trillion already disclose this kind of information on its carbon emissions, their carbon emissions. So when we were thinking about how to do estimates in our work to make our case more robust, we thought it would be only natural to use the same source of information that the European Union, the Bank of England, and the SEC are using in their policy analysis, right? So the ESG rating databases, they use the same kind of information on carbon emissions, which are coming from the GHG protocol and the carbon disclosure projects. And specifically for our work, we are using the MSCI ESG database, which comprises over 9,000 companies and bonds. And what we do to classify the companies is basically we use two criteria. So the first thing is that we use this carbon emissions weight, which is a number that tries to capture the importance to the green transition of the industry where the company is. So we're selecting the 35% highest weights, which means that we're effectively dealing with firms that are in the most energy intensive and fuel intensive sectors in the economy. And next, there is this second criterion, which is the carbon emissions score, that effectively grade the company's actions on low carbon technology and what they are doing to improve their energy and carbon efficiency. So here, what we do is more straightforward. Firms scoring low in this criterion, we classify them as carbon intensive, and companies scoring high, which means that they are actively contributing to the green transition, they are what we call the green companies. And finally, because we're trying to get some estimates out of this, we cross this this methodology with the S&P 500 companies to get the behavior of stock prices in order to estimate returns on green and carbon intensive firms. So basically, this is the graph where we plot our results. So as I told you before, we're using S&P 500 stock performances between 2010 and 2021, and then we apply the fast Fourier transform, which is a way to select the low frequency oscillations of the time series. So you can see here like one of the stylized facts on climate.
I get a note here that we are stuck on slide 10. Is everybody seeing the slides, or is that?
That was before Willi. It's fine now.
Oh, that's fine now. Okay, thank you.
Okay, thank you, Willi. But anyway, the result of our estimation is this one that we plot in the graph here. So we move on to the final section in our presentation, in our paper, which is trying to understand what happens to the investor's decision in different tax schemes, right? So we use for that this dynamic portfolio model, which basically is one investor that has to choose between three different assets: safe, green, and carbon intensive assets that have time varying returns. So basically, this investor is maximizing the intertemporal utility. And equation 4 here, we have the equation that tells the law of motion of wealth. And basically, it decreases as the level of consumption because of the level of consumption, and it decreases based on the returns on investments chosen by the investor. And the key variable here is this pi2 variable, is the share of assets effectively allocated into green companies, right? So we run this model for 40 periods to get a sense of what happens dynamically to this investor, right? So the first result we found is that when we apply a classical carbon taxation in this system, which is the taxation that is levied on products or consumption, very few things change. Mainly, the only thing that gets that changes is the consumption level, which of course is expected because carbon tax is by and large a consumption tax. So investments decisions are more or less unaffected by it. So here is one of the key ideas here is that when we introduce a taxation on carbon intensive wealth, we are doing something that classical taxation is not doing, which is altering returns and altering investment decisions. So in this graph, we just keep track of the path of wealth in different scenarios. We're doing some simulations, basically with 20% tax and 40% tax, and the case where we use the tax revenues to fund subsidies, and when we just don't use the tax revenues for subsidies, right? So we see that for 40% taxation, there is a meaningful change in the pattern here. So especially in the middle periods, wealth stops decreasing or decreases less intensely. And because we're dealing with a dynamic setup, even in the later periods, the wealth path is slightly higher in the case where the taxation is higher. And what happened is counterintuitive, but what is happening behind the scenes here is that the investor is choosing green investments earlier on, and that has long-term consequences and beneficial consequences to the wealth path. Like these two graphs, I'm showing how the returns change given the different tax schemes we're simulating. And you can see that for the majority of the periods, what happens is that the returns are altered in the early periods. And finally, here I plotted the pi2 variable, which is the share of green investments the investor decides to invest. And we see here, we have a sense of how effective this taxation is, because especially in the early periods, the investor chooses to allocate more on green firms. And this is really important in the climate transition context, because we know that early investment is one of the crucial elements to the green transition. So moving on to the conclusions, basically what we wanted to convey here in the presentation is that the carbon wealth tax actually is a necessary measure, because we do need more climate-oriented policy. And this one in particular targets divestment away from carbon-intensive capital. It is feasible in the sense that it is an additional high capital gains taxation on carbon-intensive companies. And insofar as the disclosure requirements from the regulatory agencies go on and move forward, the implementation will be even easier in the next years, because the information will be more widely available and is effective. If the tax is high enough, it can shift the returns on carbon-intensive and green assets, and therefore it changes the portfolio decisions. That means that the investor allocates a higher share of capital to green economies, and that means basically that there is more finance to the green transition. And it also ensures a better long-term wealth path. Also, we have to finish the presentation by saying that is a good policy tool against rising inequality, especially of wealth, which is a pressing issue nowadays. And it's, of course, a better sharing of public goods that in our case is a public debt. All right, so yeah, let me stop sharing here. And I guess now, Rafael.
Yes, let me share my screen. And I will check that I can change slides. Is that changing for you? Okay, great.
Yes.
Well, thank you very much. This was really a very interesting proposal, and thank you for the invitation to be part of this panel. And thank you to the Henry George School for organizing. So I'm just going to give maybe some context to the issue of income inequality and also wealth inequality, and then I'll try to relate a little bit with the presentation we just had in terms of the drivers of inequality. So I couldn't resist but to start this presentation by showing you this cover of The Economist, May 23rd, 2019, celebrating the so-called unprecedented jobs boom. And what this was about was very low unemployment rate, right, which had dropped to a 50-year low of 3.5%. And so The Economist was celebrating this, but of course the full macroeconomic context of the past 40 years suggests that for the majority of workers, this has been a very incomplete and misleading picture. And so any recent wage increase is barely making up for lost ground in the past decades. And if you look at, what I roughly describe as a labor squeeze, this is primarily looking at income. You will see a decline in the labor share in total national income in the US. You will see the so-called wage productivity disconnect, which is the idea that wages have fallen out of whack with increases in GDP and increases in corporate profit and have been stagnant. You will find increased precarity and earnings volatility for households, and you will find a changing nature of the American work contract with more precarity and fewer benefits for workers. I could show you a couple charts that you may or may not be familiar with. This is the fall in the labor share in the past decades. The labor share is the proportion of national income that goes to waged workers. You see at the end right there, like this picks up, and I guess this is what people have been calling the Great Resignation during COVID. Increasingly, people quitting their jobs and renegotiating salaries, apparently. So this actually shows up in the labor share. This is the, I'm a big fan of this chart, the productivity pay disconnect. This is the Economic Policy Institute. And you really see in the late 70s, the sort of flattening of the hourly compensation growth as compared with increases in GDP and productivity. And so you get this compounding effect where at the end of that process where wages are really behind. This is an increase in income volatility. This is the work of Jacob Hacker at Yale. Unfortunately, he sort of stopped doing this in 2004, but this was a very interesting approach, looking at the increase in the volatility in family income and seeing the increase in volatility. So more uncertainty for people with higher standard deviations of their income. And then finally, this is the World Inequality Database. This is the work of Piketty and some of his co-authors. And one of the major contribution of Piketty is the use of tax data, right, to try to figure out wealth and income. So it's an interesting methodological approach. Now, according to Piketty, it's the distribution of income that is actually a key factor accounting for. It's the distribution of labor income, so wages, which is a key factor in the evolution of income inequality today. And so what he identifies is the explosion of these very high incomes from labor that have been observed in the US since the 1980s. And this idea that the working rich have replaced coupon clipping rentier. And that's the idea that if you look at people at the very top of the income distribution, they tend to be waged earners, right? They derive a salary. And so for Piketty, the overperformance of the top 1% of wages is actually what explains nearly 3/4 of the increase in inequality since 1970. So it's primarily a story about wages in Piketty. And you can kind of relate to this idea by looking at CEO to worker compensation, and you see this explosion in these top salary, the so-called super managers. These are CEOs. By the way, about 60% of top salaries have to do with CEO compensation. 20% has to do with finance executives compensation. So primarily, we're talking about CEO to worker ratios going up. Okay, so that's for income inequality. Now, is this to say that wealth inequality is not relevant? Of course not. So these income measures fail to account for the full picture and for all dimensions of inequality and even income inequality, and specifically don't really adequately reflect all of the advantages of asset ownership. So in the literature, you'll find lots of people arguing that wealth inequality is arguably needed in order to have the full complete picture of both wealth, but also income inequality. And historically, you'll find that the ownership of wealth and the ownership of capital income has always been more concentrated than labor income. So I pulled these data from Piketty that in all known societies and at all recorded times, the working class, so the bottom 50%, generally owns less than 5% or close to 5% of total wealth. The top 10% generally owns at least 60% of wealth and up to 90% of wealth, right? And this has been like across countries, across time, as a kind of a constant. So wealth inequality has traditionally been greater than income inequality. Now, in the US, the rise in top wealth share has been well documented. There's the work of Edward Wolff at NYU. What's interesting about the wealth distribution is that if you look at the very top of the wealth distribution, so like people in the Forbes 500 or 400, you will find power law dynamics. So the distribution changes and becomes a power law, essentially. For Saez and Zuckman, the rise of wealth inequality is almost entirely due to the rise of the top 0.1% wealth share. And the statistic is really interesting, right? 7% in 1979 and 22% in 2012. So again, we have a story of the tippy top sort of driving the increase. This is the original chart figure from Piketty. You may recognize this wealth inequality in the US over a 200-year period. You'll see the top 1% and top 10% wealth shares, and you'll see this dip in the first half of the century, which Piketty attributes to a number of shocks, right? Wars and fiscal shocks. And then you'll see that kind of stabilization in the post-World War II period, and then the wealth share of the top 10% and 1% starts going up again. Here's some more updated data, again, from the World Inequality Database, showing you the evolution of top 1%, top 10%, and middle 40% share. And these are going in the direction of increasing wealth inequality. So what are the drivers of this? So Piketty's main hypothesis, you may be familiar with, is the famous RG differential, which is the idea that when the rate of return on capital exceeds the rate of growth in the economy, i.e. GDP growth, then this automatically leads to an increase in the share of capital income in national income. So you'll find less going to wages and more going to capital. And this leads over time to an increased concentration of wealth. Now, the Piketty himself doesn't really have an explanation for the exact mechanism for this, especially when we look at the concentration of wealth. You know, he mentions in a footnote of chapter 10, there's a reference to the technical annex of the book. And when you go to the technical annex of the book, you'll find that it can be found in dynamic macroeconomic wealth accumulation models, that when you have a difference between the rate of return on capital and the rate of economic growth, then it impacts equilibrium wealth distribution, right? And he shows that the Pareto coefficient of the wealth distribution is a function of this RG differential. So it's kind of buried, in the footnote, the appendix, and not necessarily unpacked very well. But so here's the evolution of RG differential, and you find that the collapse of R in the first half of the 20th century, right, combined with the increase in G is what led to the a decline of the capital share, and this is now being reversed. So maybe the missing perspective in Piketty that is interesting to think about, and also relates to the framework for the tax on carbon wealth is this more macroeconomic perspective, right? Looking at the evolution of net worth and evolution of financial portfolios over time, and understanding investor behavior, and seeing if there's any link between the wealth distribution and investor behavior. And what's pretty striking is that there are differences in not just wealth, but the return on wealth, right? The rate of return, so that wealthier investors tend to earn higher returns in the long run. And there's a couple of statistics in Piketty. The top 1% earned an average annual return of 5.91% between 2010 and 2013, but the middle three quintiles of the distribution earned only 3.27%. And so if you want to understand what could be driving these differences in return, right? So it's not just R, but it's the distribution of R. Then you have to approach the issue of wealth inequality and the process of wealth accumulation from a more macroeconomic perspective, where you're more focused on investor behavior. So this allows you to think about some drivers of wealth inequality, such as the impact of the asset management industry on wealth inequality, the impact of better performing investments and higher returns for some investors, and ask the question of how wealth inequality is shaped by the performance of global financial markets. So I'll show you three dimensions to this, right? Three different approaches in the literature of thinking about this. First, investor level characteristics. So when you look at factors such as factors that drive savings rate, right? So things like time preferences, bequest motives, liquidity constraints, but also differences in investor parameters, such things like risk aversion or investment horizon. You will find that differences between investors are a key driver for inequality in the wealth distribution. And you will also find that rich households tend to save at higher rates. So investor level characteristics are relevant. The second approach in the literature is to point to luck as a driving extreme wealth inequality. Now, at first that sounds a little bizarre, but the idea here is if you take the efficient market hypothesis seriously, right, then the market produces winners and losers. And so some people have gains, some people have losses. And when you have multiplicative return dynamics, these differences actually, when they're compounded, actually lead to Pareto wealth distribution. So the impact is multiplied in the system through these compounding effects. I don't find this hypothesis very compelling. I think it's more of a theoretical exercise of doing simulations, but ultimately I don't really buy the idea that luck alone is responsible for the increase in wealth inequality. The third hypothesis, which is quite compelling, is the idea that wealthier investors get higher returns. And there are two ways that they can do this. They can have higher betas, so they have the ability to take on more risk. And when you take on higher risk levels, you tend to get higher returns on average, and that's called the beta. Or you can get higher returns per unit of risk, so you don't even need to take more risk. You just get alpha, which is a return over and above the beta. And so looking at these two drivers of higher returns for wealthier investors, it's really an invitation to, again, think not just about the RG differential, but the distribution of G across investors. And I'll show you why that might be something interesting to think about. First, if you consider the composition of wealth, of household wealth, this is between 1983 and 2016. This is Edward Wolff. And well, what you notice here, this is, by the way, the aggregate composition of wealth. So it's not broken down yet by different wealth levels, but you'll find that liquid assets have decreased. But most of that has been shifted into pension accounts, right? People's retirements. And then you'll also, maybe you'll note that you have higher debt income ratios. So people tend to have more debt than they used to. So that's the evolution during that entire period. But now look at the picture if you focus on the composition of household wealth by wealth class. So you look at the top 1%, you look at the next 19%, and then you look at, you know, the middle class, the middle three wealth quintiles. And what you'll note here is quite interesting, that first, for the middle class, right, the home is the primary asset that they have. That's a driver of their wealth, but that is not the case at all for the top 1% or the top 20%. You'll find that the top 1% tends to invest a lot more in securities and stocks, as well as you know, directly into businesses. And of course, they have less debt. Now, it's what's interesting there are these different allocations in the portfolio, which could explain differences in return, and particularly wealthier investors' ability to be much more invested in financial assets would be a key driver. Whereas for the average person, you would only get the rate of return on a savings account in your bank account, you know, which has been very low as of late. So here's another table that is kind of interesting to look at, which shows you the return on capital endowments of different US universities. So it's showing you by size of the endowment what the rate of return was. And this seems to suggest that higher endowments have higher returns, right? So if you look at the Harvards and Yales and Princetons and endowments higher than 1 billion, they get higher rates of return than smaller endowments. Why endowments? Because the data is publicly available, so it's easy to look at the data. So this was in Piketty, right? And this was what originally brought my attention on these issues. I thought it was quite interesting. Now, why would wealthier investors get higher returns? Well, they have access to sophisticated asset managers. And even now, asset management is changing. This is a slide which I took from Apollo, a presentation of Apollo, you know, the big private equity powerhouse, to its investors. And Apollo is now claiming that the old world of portfolio management, you know, this 60-40% allocation to equity and fixed income is now a thing of the past. And so now what's really important in an environment where public markets are not delivering as much alpha as they used to, what's important now is to have some allocation to alternatives in your portfolio. And, you know, they call this the fixed income replacement strategy as the next frontier in the evolution of investor allocation. So what that indicates to me is, hey, if you have access to this more sophisticated portfolio management, then you'll get higher returns than if you don't. And I'll finish by showing just a remark, right? The idea that alternative investments now play a material role in the investment portfolios of high net worth individuals could be interesting to think about. Now, when you look at Apollo, they have recently merged with an insurance company called Athene. And if you look at the return of Athene's alternative investment portfolio over the past 9 years, and this is very recent data, I just pulled it off their investor report. Over the past 9 years, they've generated 12% annually. Now, here's the thing, right? These returns are delivered by Apollo's skill as an alternative investment asset manager. If you are an Athene annuity holder, you only get 2-3% on your annuity. But if you are investing in a private equity fund that then is being managed by Apollo, you'll probably get a much higher share of those returns because you'll only be paying management fees. So the point here is that it's interesting to think about how sophisticated asset managers are delivering superior returns. And it's interesting to think about the availability of those returns across the wealth distribution, the impact that might have on wealth inequality. And that leads me to perhaps circle back with the carbon tax that was just presented to us. That would be a great way to kill two birds with one stone, right? Which is make more funding available to finance the green transition, but also tax those high returns that can be generated on non-environmentally friendly assets. And so my question here would be, I guess one question I have is in terms of identifying these companies and relying potentially on disclosures and disclosure frameworks to do that, how to think about private companies that are in private portfolios that maybe are managed by private equity funds like Apollo, if they don't report, if they don't adhere to these disclosure frameworks, what do we do? Because there has to be a way to be able to also, assess the tax on returns that are generated through these types of private alternative investments. So that would be one question I would have for our panelists. And maybe I'll pause here and stop and see if we have some questions, so we have some time for Q&A, because we're running out of time. Sorry. Stop my share.
Thank you very much, Raphael, and thank you very much, everybody. Willi, did you have something that you wanted to add?
No, just one. Raphael did very nice job to show the more general drivers for wealth inequality, like saving rates. So more assets, higher income, higher wealth, you save more than other people. Secondly, the returns, very driven by the fact that you already have wealth and you already can exhaust economies of scale in terms of management and knowledge and information. And that was an old argument of Arrow already. So that's where then the investment horizon, what you mentioned. So I think she did a good job to explain what forces are there at work to get the rich richer with higher returns and higher expansion of wealth, and particularly 1 or 10%. This is, I think, is very good job that she explained. I was wondering, there is basically from your first statement to your last, there is a link, namely the falling labor share, the rising asset prices through cash flows of firms, discounting gives higher value of firms, and wealth distribution. You see, if you try to do the link, there are actually econometric and macrodynamic papers on this now, who link basically the falling labor share to the rise of wealth accumulation. And this is a good, I think, link that you may want to point out. Point out. It was your first point there. The last is very, I think, a very important point. This is one of our major difficulties, actually, to the identification problem. What is the carbon-intensive wealth and what's not carbon-intensive wealth? And any progress on this, any idea of this, any measurement of this, any data source of this that you could pass on to us would be very useful, I think, to go ahead with that. And your remark that the public company, yes, they are easier to track, and the SEC tries to enforce them to do the report on disclosure, but private companies also not. That's true. But the question that I may have you as a lawyer, though trained lawyer, do you see any obstacles in the legal world coming up, so to speak, against this differentiation of CO2 emission across companies and in somewhat penalizing them, as they would say, Yeah, so it starts going on in the industry already. You can't penalize us. So as a lawyer, do you see any legal obstacles there? Also, do you see as a lawyer any legal obstacle that the Internal Revenue Service, for example, could use the data on income from assets that could help us to identify actually income or returns, capital gains from dirty assets and from clean assets? Would there be any obstacle? Or it seems to me that the IRS have those data already, but do you see any obstacle to obtain those things? I mean, legal obstacles. So that would be my questions to Raffaele, because she's a great legal scholar as well, and you have to think about those terms as well if you start proposing something, you know. Mm-hmm. Okay, so that was my question. Thank you. Otherwise, great comments and great extensions of what we actually did and intended to do.
Well, this is a great question, Willi. I have to first be very humble here because I haven't practiced tax law in over 10 years, and that's a good thing. I'm happy about that. I don't think there's legal obstacles as much as logistical obstacles. And, you know, the IRS is severely underfunded. They don't have all the resources to do audits that they should be doing. They, you know, so a lot of things fall through the cracks. So any kind of ambitious proposal like yours, it's just about implementation, like being able to pull it off. But I don't think there's a legal obstacle. And they have the data. I mean, they could impose the reporting to broker dealers to mandate kind of an assessment of what percentage of capital or capital income or dividend, you know, what percentage comes from, you know, dirty companies. I could imagine that being done. You know, you would have to have maybe like a database that these broker dealers would draw from to be able to do this estimation. So they could also pass it on to industry participants if they wanted as part of the reporting.
Okay, very good.
Thank you. I also have a question before I hand it over to the audience. It may not be an economist's question, but anyway, I will ask and see if you guys have a take on it. It has more to do with what we call the free rider problem. Assuming that the US and Europe, for example, decide to go for this brown tax idea, which I think really makes sense. Do you think it would really be having any impact on the problem you are trying to address, which is climate change, if other countries could decide to say, well, we will stick to brown assets without taxing them so that we can extract a competitive advantage? we know, for example, that China, which is the biggest polluter, is responsible for 28% of emissions, and India, Russia, and Japan combined, they pollute as much as the US do, which is 15%. So if you have those countries that I've just listed out of a framework like this, what would be its effectiveness? Did you think of putting it out for like an international treaty, for example, something that will get all those countries, or should it be dealt with using the trade mechanism or so on? What's your take on this? Yeah.
Jose, do you want to answer?
Well, I think that as in all types of taxation, you have to have some sort of international coordination to implement worldwide. So that's what we're seeing also with the global minimum corporate tax. They are trying to come up with a international proposal, because of course you have this problem of capital moving to countries where there's no such a taxation. So traditionally, the way people think about this is trying to, for instance, in the case of corporate taxation, that the countries that don't charge this taxation would be taxed like when goods are exported, for instance. So you have like this kind of countermeasures to try to cope with that, but definitely is I think it's one of the challenges regarding this proposal.
Okay, you mean countervailing duties under WTO?
Yeah.
Okay, makes sense. Good. So we're gonna open it now to the audience. I just want to ask you to make it brief. Don't overextend your comments or questions. We have another 15 minutes left. So I see Yanis raising his hand. Go ahead, Yanis. You are muted. Okay, go ahead, Yanis.
Yes, thank you very much, all three of you, for your very thoughtful presentations and your research work. My first question is again going to be a little bit on the semantic side, because I think the term green is not well defined, and the term clean is also not well defined. Because you have to think, the energy sources that you call green, they're not really green at all. Actually, they're much dirtier than fossil fuels, okay? And they will have much more environmental impact to implement them than fossil fuels. Just think, for example, how much extractive mining you need to do to get all the rare earths and all the minerals required to make the solar panels. That would substitute fossil fuel, okay? Plus the so-called renewable resources, they don't have the resilience and reliability of fossil fuel, so that make them even grayer than they actually are. Okay, so how you define that? It seems to me you make an assertive definition. I call green this, and I wanna promote this, but I don't think that's necessarily to the best of the economic and societal interest to begin with. So you have a conceptual issue there. I would like you to address that. And then I have more, but I will wait later for another question. In other words, you may need to tax green the companies that you call green. You may have to tax them because they use carbon in order to produce. And for example, we know that with the solar panels, China is playing that game. The solar panels that China is producing are very dirty, okay? And so what are we gonna do about that? Thank you.
Thanks. Who is gonna go for that? You wanna take a stab at that, Jose?
Yeah, I think, well, thank you for your question. I think it's really important and thought-provoking. I would say that, well, first of all, we have to keep in mind that we have different and several challenges when it comes to the climate transition. When we think about the carbon tax, we are really thinking about CO2 emission. So even though I agree with you that the mining activities are really damaging for the environment, if in the end we are able to produce less carbon, release less carbon into atmosphere, it's something that I think it's the most pressing issue we are facing. But I agree with you that this is something that really requires more a better definition. And in that sense, there are some really interesting initiatives especially in Europe. For instance, the European Union taxonomy that I referred to briefly in my presentation. It really relies on us coming up with specific actions that the firms would have to do in order to tackle the climate transition. So it's not only about saying it's not like not defined, you know, like there is a work to tell specifically what this kind of firm in this type of industry has to do in order to contribute to the green transition. And that's really what we ultimately want to incentivize.
Yeah, I don't have anything to add. Yeah, great. But it is a serious question. The environmental impact, you know, on all industrial mining, agricultural, industrial, oil refining, or hydrogen power generating things, all use still fossil fuel stuff, and all have environmental effects. So, and this is an important question, but we are focusing on the CO2 emission there.
Great. James.
Well, thank you very much. This is a question for Professor Schappa, and I'm probably mispronouncing your name. I apologize. I was not able. Okay. Is that the correct pronunciation?
Shap, but don't worry about it. Not an issue at all. Yeah.
This question is about Professor Joe Stiglitz's analysis of Thomas Piketty's book. He said in an interview, this is 3 sentences long, and then I'll stop, but I want to give you a complete opportunity to respond to his analysis. Professor Stiglitz says that most people get the impression upon reading Dr. Piketty's book that there is a link between the growth of the economy, the accumulation of capital on the one hand, and inequality and wealth. My paper, meaning Professor Stiglitz's paper, begins with the observation that in fact you cannot explain what has happened to the wealth-income ratio by that analysis. A closer look at what has gone on suggests that a large fraction of the increase in wealth is an increase in the value of land, not in the amount of capital goods. End of quote.
Well, at the beginning of the quote, when he says link between the growth of the economy and the wealth distribution, the argument, to do justice to Piketty, is really that differential. So it's not just the growth of the economy, but rather it's the rate of return on capital exceeding the growth of the economy. I have to say, I like the idea that some of that wealth is just inflated asset prices and inflated real estate. I think there's some truth to that. During the pandemic, you know, the price of housing has just gone through the roof. That seems to be completely disconnected from economic growth, right? We're in a pandemic. So I think that could be involved as well. I don't think Piketty would necessarily disagree. You know, I haven't read the book in a while, so I forget if he's paying close attention to that. But so I think both approaches could be reconciled or could be at work simultaneously. I think, the RG hypothesis, if you start to try to do some statistical analysis, you'll to find out whether it's true or not. The devil is in the detail, right? It can be hard to prove or disprove. So I think it's just a helpful model to think about some factors driving inequality, but I don't think it's the be all end all, magic kind of equation that gives us the solution to all the problems. That makes sense.
Thank you.
Thank you. Ed Dodson.
A lot to think about for sure. And I'm trying to merge in my mind the different presentations that you've made. One thing that occurs to me, my background is in housing, which I try to get people to describe as a residential property market as opposed to a housing market because of the land component. And one of the things I wonder about in the data is tracking depreciation, because a housing unit is a depreciating asset that requires constant infusion of labor and materials and even debt in order to maintain, and then every 10 years or so, systems replacement. So that's my first question, is to what extent the data tracks the ongoing maintenance cost for housing units as opposed to the depreciation that would contribute to declining values. And that would tend to suggest that the land market is actually increasing at a faster rate than reported. And the second part of my question is, how do we prevent multinational corporations from doing what they do now? And that is, they shift to the locations where the tax rates are lowest, their expenses, their income, and shift to where the tax rates are highest, their expenses.
Right. Raphael, you want to take a shot at first part?
The question about depreciation was, you mean in Piketty or in?
Just in general, in terms of what data is available to economists who are looking at the markets, who are trying to determine, the ratio of income and wealth distribution.
But these are two things, real estate value and land value. So they are two different things, I guess. You're talking about real estate value, right? One should take into account depreciation cost and investment to keep it as the value intact, so to speak. But it doesn't respond too much to the Stiglitz argument. He sees the value of land as a quite dominant force as a component of wealth, though through agglomeration of cities and land value rising because of big shopping centers or other big centers in the cities, or value of land is steadily rising. But this is different from the real estate value, so the houses or things that are built on the land, I think. But anyway, I'm not an expert on real estate value. So.
Let me rephrase it in a sense from a measurement standpoint. If rent is an income stream, then the price of land is a capitalization of that rent by some discounted rate. So how do you determine the rate in the market system subject to depreciation of the actual capital improvements?
Well, in technical terms, in the asset pricing, you would take this into account of your actually income flow, the rent that is generated over time, discounted, and you would take it into account either in the discount rate or in your flow variable, the income variable. So, but you are saying it's not taken into account properly. So I don't know. I'm not an expert on this.
Mine's really just a question to the three of you as more expert than I am.
Well, you apparently know the real stuff.
Great. Thank you. Tom Rossman.
Yes, hi, thanks. Wonderful presentation. A couple of questions. So as Rebecca Henderson points out in her work on how to shift to a net neutral carbon economy, she points out that the accounting system is extremely important in that effort to manage that process logistically. So the question is, how quickly or how far away do you think we are from having an accounting system that really will allow corporations and also those that are holding these corporations accountable to incorporate the carbon issue into their books and into their financial reporting? And then secondly, considering the fact that something that I think most people would consider a no-brainer, which is a global wealth tax, global minimum wealth tax, doesn't look like it's going to be able to get done now. How difficult do you think it will be to get something meaningfully implemented that actually will work and will hold countries accountable?
Yeah, well, in the accounting systems, the national or the accounting system of corporations, so those are a little bit short-sighted, about some short-termism is working there. For the national, as well as for corporations, I think. For the national, for example, all the huge side effects and externalities and long-run effects are not taken into account in accounting systems. Countries get richer when they deplete the natural resources. So you move stocks of research into flows, they get richer. Are you really richer? But the accounting system says, yes, you are richer, but you're depleting your resources. The same with environmental effects or CO2 or long-run CO2 emission effects and disasters that will somewhat come. So the national systems, accounting system, are not taking this much into account. So the corporate accounting is also very short-termism working there. Basically, it's not only the cost and flows, so the income statement, but then the investment and the financing side of that is driven by short-termism. So you are correct. There needs a lot of correction to be made. I think I only can say that we have tried to do this with some companies, but the data are just not there. So you're correct that. But we have a whole profession, in the US, the accountants, corporate accountants and others. I think that would be a great job for them to go a little bit ahead of in what we have now. I think, the other on global minimum wealth tax, I don't think it's where we were. I don't know if that's coming close to some agreement. The global minimum tax of corporations, that is coming now to an agreement internationally, yeah. But so that means the corporate income tax is this, that comes to an agreement, 15% or what across the globe. But the global minimum wealth tax, I have not seen much progress there. Are you referring to specific suggestions there, or who was this? Tom, yeah, some specific suggestions and proposals there. I'm not aware of this so much, or maybe Jose knows more.
No, as far as I know, the one that they were discussing was the minimum corporate tax. And
the minimum corporate tax, yes.
Yeah, for wealth taxation, at least the latest figures I have seen was a decline on the number of countries that are opting for a wealth tax.
Great.
If I can add really quickly on the accounting, I know that Harvard Business School has this thing, impact weight accounts. They're like trying to develop some like alternative accounting for externalities, and there are also small nonprofit. There's one called Rethinking Capital. They're trying to develop alternative accounting methodologies, but the issue is how to get investors and companies to adopt them.
Mhm.
That's all I know, but it's not being adopted, you know. But there are some ideas out there how to do better.
Yes. It's long, yes.
Great. Well, it looks like we've reached the allocated time for this event. I'd like to thank you all for participating. And if you happen to have any additional questions, feel free to email them to me. I'll be happy to forward them to our great speakers. Thank you very much for attending.
Okay. Thank you very much, everybody, for coming here. And we had a great discourse and discussion. And there was a little bit of balloon that we tried to start to see what the response of a broader audience is on our work. But that's not the finished work. We just explore the opinion of experts and also colleagues like you, and to see what the response is. And also, so thank you for coming, and thank you for the Henry George School for organizing this.
Thank you.